Most people in their 20s chase income. Very few build wealth. And that difference decides the next 30 years of life. In India today, a 25-year-old earning 30,000 rupees a month has a bigger advantage than someone earning 2 lakh at 40. Not because of talent, not because of luck, but because of time. Time is the most powerful financial asset, and your 20s control how powerful it becomes. If you start early, 5,000 rupees a month can grow into crores. If you delay, even 50,000 rupees a month may struggle to catch up. Most people realize this too late. They earn more, but wealth still feels far away. Because income alone does not build wealth. Systems build wealth, habits build wealth, and disciplined investing builds wealth. In this video, we break down the exact roadmap, step by step, simple, clear, practical for India. If you are in your 20s, this may be the most important financial lesson you learn. This video is for educational purposes only. I am not a SEBI-registered investment advisor. This is knowledge, not personal financial advice. Markets carry risk. Returns are not guaranteed. Do your own research. Consult a certified professional if needed. Your money, your responsibility. Step 1. Build your financial foundation. Before investing, control your cash flow. Know how much you earn. Know how much you spend. Track everything for 1 month. Rent, food, subscriptions, impulse purchases. Most young earners lose wealth here, not in the market, but in uncontrolled spending. Follow a simple rule. Save first, spend later. Target saving at least 20% of income. If you earn 30,000 rupees, save 6,000 rupees. If you earn 50,000 rupees, save 10,000 rupees. Automation helps. Set automatic transfers on salary day. Money saved early compounds longer. Step 2. Build an emergency fund. This protects your investments. Without this, one crisis destroys everything. Medical bills, job loss, family emergency. Your emergency fund should cover 6 months of expenses. If monthly expenses are 25,000 rupees, your emergency fund should be 1.5 lakh. Keep it in safe places, savings account, liquid mutual fund, not stocks, not crypto. Safety first. Once this is ready, then investing begins. Step 3. Start SIP investing. SIP means Systematic Investment Plan. You invest a fixed amount every month. For example, $5,000 every month in a mutual fund. Month after month, year after year. This removes emotion. No market timing, no guessing, just discipline. If $5,000 grows at 12% annually, in 20 years it becomes around $50 lakh. Increase SIP with salary growth. $5,000 today, $8,000 next year, $12,000 later. This is how wealth quietly grows. Step 4. Understand asset allocation. Do not put all money in one place. Diversification protects wealth. A simple allocation for young investors: 60% equity mutual funds, 20% debt or fixed income, 10% gold exposure, 10% cash buffer. Equity builds growth. Debt adds stability. Gold protects against uncertainty. Cash gives flexibility. Allocation reduces risk, even when markets move wildly. Step 5. Understand market risk cycles. Markets move in cycles. Bull markets, bear markets, corrections, volatility. In your 20s, volatility is not your enemy. Time is your shield. When markets fall, SIP buys more units. This lowers your average cost. Many beginners panic here. They stop investing. They sell at losses.
That destroys compounding. Stay consistent. Market cycles reward patience. Step 6. Rebalance your portfolio. Over time, allocations change. Equity may grow faster, or debt may dominate. Once a year, rebalance. Bring allocation back to original structure. Example: if equity becomes 75% instead of 60%, shift some profits to debt. Rebalancing locks gains and controls risk. Professionals follow this strictly. Retail investors often ignore it. That is a mistake.
Step 7. Understand basic taxes. Taxes affect real returns. In India, equity held above 1 year attracts long-term capital gains tax. Currently, 10% on gains above 1 lakh rupees. Short-term gains are taxed higher. Debt funds follow different rules. Also explore tax-saving instruments. ELSS mutual funds under Section 80C, Public Provident Fund, Employee Provident Fund. Tax planning increases effective returns. Quietly. Legally. Step 8. Avoid common mistakes. Lifestyle inflation. Buying expensive gadgets every year. Chasing stock tips. Trading daily. Following social media hype. Trying to double money quickly. Wealth rarely grows that way. Real wealth grows slowly, quietly, patiently. Step 9. Scale investments with income. Your greatest asset in your 20s is earning growth. When salary increases, SIP must increase too. Example: 5,000 rupees SIP today, 10,000 rupees after promotion, 20,000 rupees in 5 years. This scaling multiplies compounding power. Income growth plus investment discipline creates exponential wealth. Step 10. Adopt a long-term mindset. Wealth building is not exciting. It is repetitive. Monthly investing. Annual review. Patience. Silence. Ignore noise. Ignore panic headlines. Ignore market drama. Consistency beats brilliance. Discipline beats emotion. Always. Your 20s are not just for earning, they're for building financial leverage. Every SIP you start today, every disciplined decision, every avoided impulse is a message to your future self. 10 years from now, that future version of you will look back, not with regret, but with gratitude, because wealth was not built by chance, it was built by discipline, 1 month at a time.